Hello, this is Brian Resney, president of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see in the global landscape. You know, earnings season's off to a decent start. Not great, but decent. In fact, I'd give it probably maybe a B minus. We're going to see how earnings, obviously, the bulk of earnings over the next few weeks come out. And I firmly believe we'll see decent earnings growth, probably somewhere between the 6 and 8% growth rate, which is actually very positive for the U.S. economy. I look at last Friday and I look at not only the housing start numbers, which were actually pretty fantastic. I look at manufacturing, which is picking up momentum on the upside. And I look at investor sentiment, again, all positive. What this basically tells me is this, again, and I've talked about this repeatedly, that we're seeing some improvement in the U.S. economy. I think too many pessimistic people out there today, unfortunately, look at negative news and listen to a lot of news media that constantly is negative, which is what sells a lot of this news media, by the way. And that's not how you want to base your investment decisions. We're going to talk about some specific risks that I see and major risks for the investor. And in fact, the biggest risk is really what I call duration risk. Again, clients of Resney Wealth Management are properly positioned on the bond or the fixed income side of the equation. The problem is a lot of our TV and radio listeners are not. And we continue to have new clients come into our firm every day, every week, every month that completely do not understand what duration risk is. They're often working with a brokerage firm who does not manage their money nor the risk in the portfolio. But unfortunately, a lot of these investors falsely believe brokers and brokerage firms and the insurance agent is actually managing or watching their money. And that simply most often is not the case at all. But let's talk about duration risk, because this is what I see pop up probably about 90% of the time in portfolios, which is the long duration bond investments you own or investments that are interest rate sensitive. I firmly believe we're going to see slower, higher rates through 2014. This is going to be devastating for fixed income investors who have long duration. Investors who are basically stretching for yield in various investment products that pay interest. As an example, intermediate and long-term bond funds, publicly traded REITs, a lot of these are very sensitive to interest rates. Preferreds. In fact, preferreds can be quite long in duration risk, and these can be highly risky and really a speculation trade almost as you get into a rising interest rate environment and a proving U.S. economy. Again, think of bonds or interest rates like a teeter-totter. When rates go up, bond values go down. The farther at the ends of the teeter-totter you are, that's duration. That's the maturity level of the bond or the fixed income investment you own. The longer the maturity, the more volatility and risk you have to the downside when rates basically go up. We're already seeing fairly big negatives in 2013, and I firmly believe the biggest risk as we get into 2014 and probably the next 3 to 5 years, assuming again the economy continues on a stable and growing foot, is going to be duration risk for a lot of investors. Again, I want to assure our investors at Resney Wealth Management that we are properly positioned on the right side for duration, meaning we are ultimate short-term investors on the fixed income side, so we've got that risk protection in place. But it's non-clients of our firm. In fact, it could be families and friends of our clients who don't understand how bonds or varying forms of fixed income work. Again, the biggest risk we see in 2013 is a slowly improving economy, and bond investors are going to get crippled, and it's going to hurt the portfolio for investors who are on the wrong side of the fence. Another thing that I want to discuss just a little bit today is really about the emerging market economies. We had numbers that came out on China on Friday, essentially, and their GDP growth is running at about 7.7%. This is actually really good. It's slower than it has been over the last decade, but again, we're going to grow the U.S. economy this year. It's estimated around 3%. China's looking to grow somewhere about 7.6% for the full year. That is phenomenal growth. In fact, a lot of the emerging market economies are doing quite well. What's happened, though, is investors have been slowly pulling some equity money out of emerging markets, so they've kind of stagnated and kind of become somewhat relatively weak. We continue to own positions in emerging markets. We're going to continue through the end of the month. if we don't get a meaningful recap and start to get some strength back in some of these emerging market investments, we may start reducing positions and or eliminate those. But right now, we're going to stand pat with what we own, and we will be making adjustments if needed and when our decision-making process on our investment strategy dictates. Of course, if you're a client of Resney Wealth Management and you have a question, give our office a call. If you're not a client and you want to become a client, call our office, schedule a consultation. As I always tell investors, there is a difference and we invite you to experience it. Remember, we will be having a live TV show this Wednesday throughout Southwest Florida. If you're not in the viewing area, that will be uploaded on our website by the next morning so you can watch it. We also, of course, have a live radio show this week. Have yourself a safe and profitable week.